DocuSign and UiPath are two undervalued growth stocks that I think investors can buy at current prices. In this video, I'm going to share with you the company's revenue growth, their operating margins, and their cash flow from operations growth, and then compare all of that against their valuations, both on the forward price to earnings basis, and share with you my discounted cash flow valuation models for each DocuSign and UiPath as justifications for why I believe these stocks are undervalued at current prices. So let's start with revenue.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, looking at the last 3 years of revenue growth, they've both demonstrated solid increases, with UiPath showing revenue jumping to $1.411 billion, up from around $800 million in 2021. Similarly, DocuSign has grown to $2.9 billion in revenue, up from around $2.3 billion in 2021. Remember, DocuSign soared during the pandemic when people were trying to avoid interactions and social distancing. An electronic signature platform is excellent, is tailor-made for that kind of situation. But even beyond that, electronic signatures make so much sense. They speed the transaction volumes, transaction speeds of any kind of economic development, because you don't need to have people come together in order to sign a signature. You need something signed real quick. You could send it through an email and boom, you get it signed. Saves so much time and paper and cost. It's just a no-brainer. I think this industry is going to continue growing for decades until nearly 95% of signatures are electronic. I don't think it'll ever be 100%. You'll still need to have some signatures be in person, but that's a relatively small percentage of the overall contract signings that are completed. So DocuSign's growth prospects are excellent. UiPath, similarly, it's in the crossroads of automation and artificial intelligence. It's what enterprises right now are focusing on tremendously. UiPath helps businesses save costs and improve operations, and businesses are looking for that now, especially as wage costs are soaring. The cost of labor is soaring, and the difficulty of finding qualified people to fill roles is also challenging for business owners. So they've both got excellent prospects longer term for revenue growth. Operating profit margin, you see a similar trend for these two in that they are improving significantly over the years. DocuSign's operating margin is already positive at 6%. That's improved meaningfully from the negative levels it was at in 2019. UiPath still negative, but it's improving significantly at negative 12.83%. And the company's management team is forecasting solid growth in operating income in 2025. Remember, UiPath's former CEO founder is now the current CEO after pushing out the previous CEO because of miscommunication and disagreement on strategic choices. Now that the founder is back at the helm, he's working to improve the company. And I always prefer, all else being equal, a company led by the founder compared to a company led by an outsider as CEO. Of course, all else being equal, right? Everything else, talent-wise, skill-wise, everything else being equal. I like when the founder is the operator, because the founder is more interested in the success of the company compared to a CEO who doesn't have that attachment to the company as closely or as strongly as a founder might have. And the cash flow from operations, much better than the operating margins for both UiPath and DocuSign. DocuSign's cash flow from operations improving meaningfully up to 33%, while DocuSign also improving its cash flow from operations to sales. I should say UiPath was at 23% and DocuSign is at 34%. And you also see very nice trend lines of improvement for both of these two companies on this critically important metric. Interestingly enough, UiPath is demonstrating much stronger growth in the cash flow from operations to sales metric, but DocuSign has the better number overall at 33%. Now that we've looked at these two and their performance metrics, let's look at their valuations. Using my discounted cash flow model, my intrinsic value per share for UiPath was $20.50. The current market price is $15. So a 33% undervaluation here for UiPath stock when measuring by the discounted cash flow model. When I conducted my discounted cash flow valuation for DocuSign, the intrinsic value per share was $129 compared to the current market price of $87. So DocuSign stock is even more undervalued than UiPath when measuring by the discounted cash flow model. But that's not the only way I look at valuation. Another way I like to look at valuation is the forward price to earnings ratio. And even in this metric, they both look undervalued. DocuSign trading at a forward PE of 22 and UiPath trading at a forward PE of 27. UiPath is trading at near the lowest forward PE it's traded for going back 1 year. DocuSign is about in the middle of the range. Remember in late 2024, there was some excitement around DocuSign stock because there was some rumors it was going to be acquired, and that sent the stock price soaring momentarily, and then that kind of receded a little bit. I do agree that DocuSign makes a good acquisition target because it's an asset-light business, good proprietary technology, solid profit margins, great cash flow generation. And when you have those dynamics, they're usually a good plug and play option for a larger company that just wants to incorporate that technology into their suite of services. You might say, what's stopping someone larger from developing their own electronic signature software? Well, that could be the reason why DocuSign is rumored to be an acquisition target. It might be easier and cheaper for some of these companies that want to add this service to just buy DocuSign outright instead of trying to build this technology from scratch. UiPath, meanwhile, the reason it's trading at a cheaper valuation is because of the leadership changes I talked about earlier. And when new leadership comes in, they change a lot of things. And one of the things the new leadership did was to change the outlook, the forecast for 2025. And that really caused a lot of headaches for investors who were thinking about, the outlook for 2024. And that created a lot of headaches for investors and concerns from investors about what's going on here. Why is there such a different outlook when all that changed was the leader at the top? Why is the company's prospects changing all that much? So regardless of the headwinds, I think DocuSign and UiPath are excellent in terms of risk versus reward at current prices. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.